love the channel and find it useful in becoming a happy retiree. Subscribe today. Coming off a week of renewed volatility, the market has woken up. I think of the market as for some reason, a bucking bronco that has been asleep. It is back. It's awake. Down 1,095 points on the week. Dow down 4.1%. S&P 500 down 3.85%. Interest rates rising. Good economic news starting to actually be bad for the market for now. I think that's somewhat of a temporary perspective. Interest rates are going up. That's also starting to scare the market. Do higher interest rates choke off the economic expansion that we continue to see? Does it slow the economy down? So and quite frankly, we're just overdue. If you really look at mathematically, historically, how it's been from a correction perspective, just long overdue. A quick correction update. It has been over 400 market days without a 5% correction. We still haven't hit that. Yes, we had a big negative week, but we haven't hit the 5% correction mark. We're over 400 days without a correction of 5%. That's over a year and a half. 10% correction, still not there. It's been over 500. Well, it's been about 500 trading days, or about 2 years since we've seen a 10% correction, and then a 20% correction, not since the bottom in 2009, over 2,200 days, almost 9 years without a 20% correction. So not to mention, the beginning of January, the S&P 500 was up 7.5% in just the first 18 trading days with almost zero volatility. So that just can't continue. We cannot have, markets do not go straight up. You cannot have parabolic rises in equities or in any asset classes. Take a look at Bitcoin. We talked about how that could not continue. Remember, Bitcoin went from 10 grand all the way almost to over 19,000. It happened in a short period of time, and then that's crashed. And again, no asset can go straight to the sky forever without coming back down to earth. Yes, long overdue for any sort of market correction. We still haven't even hit a 5% drop. 4% just on the week. So Dow was down about 4.1%. The S&P 500 down 3.85%. Yes, it feels like a shock because we've had the absolute absence of any sort of volatility for the better part of 2 solid years. That in itself is unprecedented, and that looks as though is changed, and we're back to more normal market volatility. One item that we've been talking about that, of course, would happen at some point, and we're finally seeing it. So these corrections or market volatility, nobody wants them to happen. We're not cheering for the market to drop 600 points in a day. But we've got to remember that these are manageable drops. They are to be expected. Again, not welcome, not wanted, but to be expected. We are still in an economic environment that is very healthy. So the fundamental backdrop of what really matters is still strong. The fact that we get some sort of market-based correction, that's just normal volatility that as investors, we are investors, beyond savers, as investors, we're used to. And that's really what matters. Remember, long-term investors welcome corrections. Long-term investors welcome corrections, and you should too. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.